Fellow traders, James Stanley with StoneX and Forex.com. I wanted to look at the US dollar as we're winding up a week where the dollar really could have sold off a lot more than it did. We had a pretty big announcement at the start of the week. We had a below expected CPI report. Nonetheless, USD is working on week 3 of gains. And this speaks to something that I've been talking about for quite a while in the dollar. And if you go back to last week's video, I even warned that I was expecting President Trump to take a swing at any instances of USD strength. It didn't take long for that to show up, as it was shortly after the Sunday open that we heard of the criminal inquiry into Jerome Powell. Now, the White House refuted that Trump had anything to do with that, but there have been multiple episodes, especially over the past 6 months, where President Trump has seemingly snuffed out rallies in the dollar by indicating or pushing towards weaker monetary policy. And the Fed chair nomination that's in his back pocket is still a very big driver that I think could sway matters. With that said, price leads, narrative follows. I want to look at this from a few different vantage points, a few different perspectives, in the effort of devising strategy for next week. So let's get to the chart. Let's start chopping this up and let's see what we can make of what we have. So again, first and foremost, price leads, narrative follows, and that's one of the reasons that I think adhering to the chart, adhering to trends that show on the chart is so utterly important. So last year, when we came into 2026, it was real easy to be a USD bull. Well, the currency topped like 2 weeks into the new year, and it was as those recessionary fears showed up in March that things really began to break down and break down aggressively, might I add. We set this fresh low on day one of Q3, and since then, sellers haven't been able to make much fresh ground. US data hasn't really been all that bad, despite the fact that we have gotten 3 25 bip rate cuts out of the Fed. The dollar has just meandered within this range for now more than 6 months. When we got up here at 100 to 100 spot 22, this remains a major spot on the chart. This is the same support from September of 2024 when the Fed started cutting rates then. And it was resistance multiple times last year here in July. That was just after the July 30th FOMC rate decision. And then again in November. In November, it built a double top before finally breaking down in December. As we came into this year, 2026, it was really easy to be a USD bear. Not only do we have this dominant trend that had led into the second half of last year, we also had the recent continuation or move in that direction from the December sell-off. But it's like I've been highlighting in these videos. It's what happens as we get closer to those supports that begins to make up what might be around that next corner. And so far, we've seen a hold of a higher low, well above the swing low that came to play on the Fed's rate cut announcement back in September. Now, that said, this is still the major dividing line on the chart at that 100 to 100 spot 22 level. It's so far held, I'm going to call this 3 different resistance inflections going back to July. But that's the spot that bulls need to take out if they want to exhibit greater control here. The challenge is that this has link to the largest currency pair in the world, the most voluminous currency pair in the world. And there's a price there that remains a major sticking point. But first, I wanted to go over some shorter term technicals here in the US dollar. So when we go down shorter term, you could see where we had this low that established like on Christmas Eve, and that helped to build the falling wedge formation. Since that falling wedge breakout, it's been a rigid rally. And so I want to continue to bias this to the long side, given how aggressive that short-term rally has come on. That said, it's still the 100 level where I think things where matters could thicken. But until we get there, I have support structure at 98.98, 98.77, and in the same zone that I was following a week ago from like 98.43 to 98.50. A couple of big spots there. If we break through all three, I don't know that I would necessarily want to get bearish because then I have this bullish trend line coming into play. But a break below all three could change things. So those are the three that I'm looking at for support for now. Going into next week, I think what's really important is to look at this from a perspective of counterparts. If I am looking for USD weakness, I have an area that I like in cable. If I'm looking for USD strength, I'm still picking on dollar yen. There's some sticking points around that. But Whether or not we get the big picture break in the US dollar, I think it's going to roll down to euro. Euro is 57.6% of the DXY basket, so it takes on a really large role in dollar dynamics. But like we could see from last year, this chart shows it well. Like we could see from last year, we had that massive move in the first half of 2025, and then it just stalled. And for the past 6 months plus, 6.5 months now, this has been range bound, back and forth, gyrating price action. And Eurodollar is specifically the Fibonacci zone from 116.86 to 117.48. I've been talking about this for months. This is the zone that bulls just have not been able to take out. And we could see on a shorter term basis, even earlier this week, that 116.86 level helps to set the high. We got above it. As soon as we got above it, sellers snuffed this out, put us right back to the lows, and drove this down to a fresh monthly low that continued it to the end of the week. Now, chasing this is problematic. There's another Fibonacci retracement that I'm looking at, a shorter term one, goes from the May low up to the September high. This one's important because it's the 1593 level that came in to hold the lows a couple of different times over the past week. There on Thursday and then again on Friday. Right? So as we've gotten down towards these lows, as we've reapproached this big figure that I'm going to look at in a moment, sellers have slowed and slowed and slowed. So it doesn't mean that the sell-off has to stop. It doesn't mean that the sell-off is over. It doesn't mean that chasing fresh breakdowns could be a perilous sport, because you could see, like, we had this prior swing low on Monday, or excuse me, on Friday, that held through the open on Sunday, like right around 116.16. We got just below it, and then we snap back, and then we got just below it, and then we snap back. So it's almost as low as if these fresh lows are bringing on profit taking from sellers. That's not something that I want to chase yet or right now. It does, however, allude to resistance structure. 116.16 is a major price. This was a group of swing lows from back in December. 116.56 is a big price. This was a swing high, turn support. And then above that, of course, we have those Fibonacci levels, 116.86, 117.48, but a little further out of the equation for now. The reason I want to look at this shorter-term Fibonacci retracement is because of what happened back here in November, when we were getting the 115 tests. And 115 is that big figure. It's that major psychological level that often takes Eurodollar months to leave behind. It doesn't mean that it has to stop every rally, but if we look at this historically speaking, it's had a tendency to stop rallies. And if you think about the backdrop behind currencies, it makes sense as to why. You have actual market players like global central banks, treasury departments, and multinational corporations that are using currencies for actual usage. So when we get a pop above 115, euro seems expensive, the dollar seems cheap. If you have to make payroll in the US and your Toyota or Mercedes-Benz, maybe not a terrible time to exchange some of your euro reserves into USD, thereby helping that resistance at 115 to hold. And then on the other side of this, 105, it seems as though the euro's kind of cheap there. The dollar's kind of expensive. Maybe not a terrible time to diversify out of some USD and into euro, thereby continuing that range. And you can see, even when there's adequate or ample fundamental backdrop for a move, like we had in 2021, 2022. 2021, we had that rampant inflation in the US. Fed kept saying it's supply chain related, it's transitory. You look at dollar yen, markets weren't really buying that. Dollar yen already started to pop. But here in Eurodollar, you can see where we had started to see that dollar strength showing. But it took a few months before the pair could finally leave behind that 115 level. And even last year, when we had the rally, the initial rally in Eurodollar, 115 hits, holds, and it takes a couple of months for buyers to finally leave that behind and make a run towards the 120 handle, which ultimately failed. More recently, this came back into play in November. And you could see here where we had this lower low. Once again, sellers failed to run with it. Then we got a higher low. Look at those candlestick wicks. Beautiful illustration of support. 3-day sequence. You get a higher low on day 3. Each test around 115 failed. Test below 115, no fresh sellers. Buyers pick it up, hold the low, support rallies. We go for like a 300 pip retracement. Well, when we were seeing that 115 test go down, the price that ultimately caught the exact low, let me go back to that other chart. The price that ultimately caught that exact low was the 50% mark of the May to September major move. That plots right at 114.92. And you'll see right here. There we go. Caught that exact low in late November before that reversal took over. And right now, we have the 38.2 of that same Fibonacci retracement in play. We could look at this on a short-term basis. You could see the way that this caught the low almost perfectly on Thursday. We've had some grind here so far on Friday. Again, not something I want to chase, but it is something that gives some reference. This also highlights the potential for resistance, which could be a lower high if we hold it at a clean retest of 116, 116, 116.56 is also of note. We get a bit higher, 117.17 is a level that could play, but, realistically, what I'm looking at here off this Fibonacci retracement is not something that I want to get aggressively bearish in front of until we can get a pullback, until I can get some tighter risk outlay. For USD weakness, the pair that I still like a bit more is cable. When I looked at this last week, I tried to clean it up with a couple of different shorter-term Fibonacci levels. We've gotten grind below that. I could show you the chart that I looked at from last week, and what I wanted to see was I wanted to see a hold right there. And on Monday, it looked like we had it, but then we simply lower high'd, and then we drove right back down. So I'm reverting to an older chart that I've been showing, that I've been following for a while now. This has a support zone simply taken from a prior area of resistance, 133.53 to 133.71. But what's more notable here is what happened right in there in mid-December, right? We had resistance into support, but notice how this holds 1, 2, 3, 4, 5, 6, 7 consecutive days of tests, each with those underside wicks showing sellers failing, until buyers were finally able to lift this up and get that 135 test. That zone is what came back on Thursday and Friday. And you'll notice on the 4-hour chart, I have a falling wedge formation. So I'm still biasing USD weakness more attractively against the British pound. And this falling wedge could be a key behind that. That said, I am still looking at that same 34.14 Fibonacci level as somewhat of a show me level. Because you'll notice this has so far come in as a lower high. And so if I'm sequencing this off the 4-hour, recent lower low with a lower high, I need that to break to breach that sequence. If I get a break above that, then I could make an argument for a short-term higher high, at which point I could then look for a higher low, break of the falling wedge, bullish continuation. If I'm looking for USD weakness, this is the one that I like a bit more than what I have in Eurodollar right now. For USD strength, I'm still biasing this for dollar yen. That said, it seems as though the headlines are getting less and less friendly to the yen. We're seeing more and more accusation of intervention or intervention potential. And there was a comment this week that caught my attention from the finance minister, Katayama. She said that she spoke with U.S. Treasury Secretary Scott Bessent, and they were in agreement that one-sided moves in the yen were undesirable. Here's where the rubber meets the road for that. If we go back to what I was saying a little earlier around President Trump, it's pretty obvious that he wants a weaker USD, and the reasons why, I think, are somewhat obvious. On the other side of that, Japanese yen weakness has very much been, for a long time, a desired trait from Japanese economic policymakers, fiscal policymakers, even to that same degree after the recent election. The one party in Japan that is a bit more cautious around that is the finance minister, who's who's charged with controlling or managing the currency. So when we get these consistent runs of yen weakness, the fear is that it's going to trigger inflation in Japan. And if we look at Japanese bond yields right now, they have been absolutely parabolic for a couple of months now. And so this is a growing concern. That's why we get these comments from Katayama talking about intervention potential. That said, intervention is not a panacea. We can see multiple episodes of failed interventions in the past. A good case in point is what happened on the first 160 test back in April of 2024. That was like 1 week of weakness, and then right up to fresh highs. There was an intervention attempt right here, which did bring a pullback that lasted for a few months. But monetary policy remained tilted to the long side of the pair. Bulls simply jump back on after a 50% retracement, and then we go right back up to the highs. So, I mean, the thing that will ultimately fix that problem for Japan would be more aggressive hawkish monetary policy. And if that happens alongside a more dovish monetary policy in the U.S., even better, or probably more impactful, shall we say. Better is relative, and there could be some ramifications here. But For now, all that this means for me is I just want to be really cautious or careful of chasing yen breakouts. Very similar to what I've been looking at over the last year. If you look at these yen breaks, they're perilous to chase. Instead, wait for the pullback. Look for support, support prior resistance, support at ground psychological levels, support at Fibonacci levels. Try to keep it as simple as humanly possible. Because if we do get the breakdown, at least the risk outlay could be managed. At least the damage could be contained to a degree. At this point, I have dollar yen testing a support level at prior resistance. This is the swing high that came into play back in November. And you'll notice as we were getting closer to that 158 print, there was like trepidation that was building that intervention could eventually sway matters. Now, if you have a line in the sand like 160 that has been previously defended with an intervention, that reasonably gives a top end uh, a possibility on bullish continuation runs. And so I think that's why we saw 158 as that scare point back in November. And then as the trend continues, traders get more and more testy, more and more willing to drive this up to another fresh high. We got up to like 159.5, and that's when it started to turn again. I'm not anticipating a big twist in policy that's ultimately going to fix this. But again, what happened this week that could ultimately bring a change is the fact that both the U.S. wants this lower and Japanese policymakers want this lower. That second part of the statement, how far it spans, remains to be seen because we know the finance minister wants a stronger yen or a weaker dollar yen quote. As far as the PM, as far as Ueda, I think that remains to be seen. But we're going to hear from the BOJ next week. That could give us some insight into just what it is that Ueda is looking for. That said, again, price leads narrative follows. And at this point, I still have this at a bullish position. I have this also in a falling wedge formation. Falling wedge is a bullish breakout formation with support at prior resistance. If we get a deeper drop of support, that's not necessarily game over because we look at the daily, we're still really high up here. There's a couple of levels that haven't yet been tested, 156.67, 157.17, both of which keep the door open for buyers to make a move. For now, I think the cleaner setup would ideally be a hold of this current support at that prior resistance. If we get a breach, and again, kind of like I was looking at in pound dollar, we've had lower lows and lower highs. We need to get a break, and we need to get a short-term higher high to give the idea that buyers are going to make that move. Once we get that, we know where support needs to stick for that theme to continue, and that becomes the bullish breakout or the bullish continuation formation. Bullish continuation set up to work with the bullish breakout formation off this falling wedge. That said, what if we just want to avoid the dollar altogether? Well, the beauty of a two-sided market or a currency pair is that we could essentially do a little bit of math, right? If I'm looking for USD weakness via pound dollar, if I'm looking for USD strength via dollar yen, I could just cancel the dollar out and make pound yen as an amalgamation of the two quotes. So if we look at pound yen, the pair has been a high flyer of late. While USD or the dollar yen is still struggling to make or get up to fresh highs, pound yen is trading at fresh 18-year highs and has been continually driving higher. This week, we got a pullback as we had a bit of sterling weakness to go along with a bit of yen strength. And so far, that pullback has held right at prior range resistance. Now, again, I'm recording this video into the weekend. This is something I need to monitor as we go into next week's open. So for this support to hold, I mean, the first early steps are there. You can see off this 30-minute chart how cleanly these candlestick wicks have held. And then we even had a short-term higher high. Now I need to see a higher low hold and then another higher high on these short-term charts to give the idea that that support is coming into play, is going to be able to break, is going to be able to lead to a bullish rally, a short-term reversal of the sell-off, and then a big picture continuation of the broader trend. But this would be a way of taking advantage of those cross-current themes in the British pound against the US dollar, the Japanese yen against the US dollar. Again, another falling wedge, which is a bullish breakout formation. Go out to the 4-hour, looks like it could play pretty cleanly. Now, if that doesn't hold, if that breaks down, we have prior range support. That range support comes in right around the 210 handle. So There's a lot to work with next week. There's a lot on the data front too. Like I said, we have BOJ next week. I think that's going to have a pretty big bearing. We have U.S. course PCE next week, and then Trump is talking more and more about who he's going to nominate atop the Fed. I think that's going to have a driving factor as well in USD dynamics. But if you want to avoid the dollar altogether, pound yen is available and is currently testing a big spot of support. We'll see the way that it opens next week. But that's what I have for this week. That's what I have for this weekend. As always, thank you for your time and happy trading, ladies and gentlemen.